Welcome everybody to this recording webinar on the public country-by-country reporting directive. We have with us experts, knowledgeable experts from PwC, who will explain to you the upcoming directive and what is in it for directors. So this webinar is organized by ecoDa together with PwC. For those who might not know ecoDa, we are the European Confederation of Directors Associations, and we represent 22 national institutes of directors.
Hello everyone, thank you for joining us for this webinar on public country-by-country reporting. My name is Anne-Hélène Montsellato. I'm an independent director, currently the Audit and Risk Committee chair of Genfit, biopharmaceutical company listed in Paris and Nasdaq, and a former chair of the Audit and Risk Committee of Euronav, listed NYSE and Brussels.
And my name is Edwin Visser. I'm Deputy Global Tax Policy Leader at PwC.
Hello, my name is Katie van der Torre and I'm working as a Tech Director at PwC Netherlands, working partly for the Global Tax Policy team and partly for the Financial Services Business Unit.
Thank you very much to both of you for inviting me, facilitating this session. So our topic currently is the public country-by-country reporting, and the important point here is public. And I was interested to understand a little bit more how that articulates with the former country-by-country reporting that companies had to do, which was the non-public version. Could you please, Kathy, elaborate a bit on that?
Yeah, sure. Happy to do that. Well, the directive on public country-by-country reporting, and especially the public part, is the different one of the currently country-by-country reporting. And it's a European directive, so it is in scope the European multinational enterprises with a turnover of 750 million, consolidated. But it is also applied to non-EU headquartered multinational companies. So if they have activities within the European Union with a consolidated turnover of at least 750 million, they're also in scope. So the thing is that those countries already are familiar with country-by-country reporting. So that's the reporting towards the tax authorities. And now the different element is that they have to disclose the information publicly. So that means that they have to report, for example, on their website of the company, the tax information regarding this EU directive.
Thank you. So that will start, I understand, December 25.
Yeah, it is applicable to financial years starting on or after the 22nd of June of 2024. So in practical, it will be most of the cases, the reporting year 2025. Exactly.
Okay, so soon to come.
Soon to come, absolutely. Yeah.
But directors should really take a look at the implementation legislation of countries itself, because each country is responsible for implementing the directive, and some countries are a bit running ahead of this deadline of 2025 you mentioned.
Okay, so I understand that most of the EU countries have transposed the directive. Some of them
not entirely. There are member states which have an earlier date. So, for example, Romania or Croatia. But there are also member states which are still busy with implementation. So there are a lot of member states which received a formal notice of the European Commission. So they really have to speed up the implementation process. So we really have to push forward a little bit the member states to really meet the deadline.
Okay, so get people to have a greater awareness of this is a very good point. And Edwin, how can this public country-by-country reporting be connected with transparency, accountability, and tax governance developments?
Yeah, that's a good question, Anne-Hélène, and maybe I should go a bit back in the past, not too long, of course. Tax was, in the beginning, I think, 10 to 20 years ago, seen mainly as a cost of doing business. And it has evolved as a more strategic topic for boards. It has become more prominent because of the debate on tax avoidance that started after the financial and economic crisis in the early 10s of this century. And from being cost of a business, tax evolved as a expression how the company relates itself to society. And NGOs, stakeholders, governments expect more accountability around taxation of boards. And this is also reflected, for example, in not only in tax regulations, but also in corporate governance regulations. This started with Sarbanes-Oxley in 2002 in the United States after the Enron scandal, but also you see it reflected in the M&E guidelines of the OECD, which are the corporate governance guidelines of the OECD. And it was also picked up, for example, in King 4, the South African corporate governance guidelines, and also in the Netherlands, the Tabaksblad code. So more and more attention, more expectations around accountability and transparency for companies. And of course, NGOs, they want to have insight in what companies pay in which country. So that also pushed the debate towards where we are now, I think.
Okay, thank you. So I understand that there might be a reputational risk here for companies, and we'll come back to that in a minute.
Yeah.
Casey, what exactly companies will have to report compared to the non-public?
Exactly, the elements are quite the same, but now they really have to think about the fact that it is publicly available. So they have to report at least a description of the main activities, also the number of employees, the net turnover, a profit or loss before tax, tax accrued, tax paid, and at least the accumulated earnings. So that's a lot of technical data. So it's only numbers. So I think it is really important to think about the narrative. And they have to report it per country. So it's not on an entity based. So they really have to consolidate it per country. And I think the tax director should think about the narrative behind those figures.
But in terms of the narrative behind those figures, this narrative has already been provided to tax authorities. So should companies take the same narrative to be consistent?
No, I think the narrative towards the tax authorities is not mandatory, and it's also not written in the EU public by country directive. But I think if you only publish the numbers, then at least the audience, because that is the fact that you want to do, you want to show how you pay taxes to the society and to your stakeholders, that it really demands a narrative. Because just to give a practical example, if you pay less taxes, it doesn't mean you are avoiding taxes. It could also be the case that you're using tax incentives, for example, research and development. So it is really the narrative behind those numbers which is quite important now with public reporting.
And you see more and more companies articulating a tax strategy that they publish, but also tax principles. So it's easy to misunderstand, as Katie said, if you just provide data only. Then you can have an interpretation of your own, and you don't know the approach of the business towards taxation, the relation to the overall strategy, the relation to the sustainability strategy. So that's why the narrative, as we call it, is quite important.
I remember that there was a lot of debates at first, and then they went to the non-public version of the country-by-country reporting. So do we have experience now? Do you have experience with companies already reporting that information, how they have, made up their mind in terms of what to report, what the impact and I understand also that there was in the mining and extractive industries, financial institutions, they also had an experience reporting this type of information. So what can you tell about this?
Yeah, I think that's really a good point you mentioned, Anne-Helene, because those industries are already familiar with public country by country, especially the financial sector and the mining industry and oil and gas was already based on other directives, for example, the CSRD 4, that they really have to report already public available information. And it's quite positive, actually, because those companies can really explain to the audience how they pay taxes and where they should pay taxes, including the narrative. So it's really a positive thing, I say. And I think to see that as a practical example, it's really a front runner also for the other multinational companies now. So we really have concrete examples how they are explaining their public country by country reporting also in what Edwin mentioned, had connected to, for example, a public available tax strategy and tax principles. So it is really a connected thing how companies can report. And I think that will be helpful for the multinationals who are starting now. We do see also the exclusion, for example, to omit commercially sensitive information, because you see that companies sometimes struggle to really report on those things. That they really are looking for, okay, is it the right moment, maybe in 5 years' time, that you commit the information, then report again. So you do see there a little bit sometimes a struggle for reporting now or using that exclusion. So we will see what companies will do.
Okay, thank you. Very good point. And as with all public information, obviously, you know, when it comes to things being reported, the board of directors are involved at some point. So any specific requirements regarding directors to that respect?
May I add to the previous point maybe, Annelijn, because we have some interesting experiences, I think. You know, Katie and I are involved. Katie is running it with tax transparency benchmarks in the Netherlands. And I think 8 or 9 years ago when I joined PwC, companies were really scared about this benchmark. And now they compete to be number one in the tax transparency benchmark. So that shows how companies have changed their thinking about tax transparency. The tax debate in the Netherlands, for example, is quite heated sometimes. A lot of attention for tax avoidance. Some big companies in the Netherlands publish their tax contribution reports, very detailed. And of course they were afraid, you know, what will happen once we publish this. And, you know, that went really well because it didn't lead to any adverse media attention. Transparency, I think, takes away any suspicions any NGO could have because you're transparent about what you do. So that is really, I think, a big game changer in the thinking of companies, but also in our thinking, I think, about tax transparency.
Okay, good insights.
Sorry for the interruption.
No problem. At the same time, as you were speaking, I was thinking that tax governance for board of directors have made a huge leap, I would say, compared to what it was 10 years ago. And board of directors and audit committee in particular are becoming much more, paying a lot more attention to tax governance and how taxation reports are prepared, etc. So speaking about why should directors be involved, a certain number of directors might still raise the question of, isn't that in the hand of the tax directors? What's my take here? How should I be involved, etc.? Would you have, Edwin, some additional thoughts?
Yeah, I think so. We alluded to that a bit before, I think. It's not about publishing data only, because if you only publish data without, you know, the contextual narrative around it, your approach to tax, your tax strategy, and how the tax strategy relates to the business strategy, the sustainability strategy, then taxes can easily be misunderstood. It's a very complex area. You have the traditional taxes, income taxes, property taxes, consumption taxes, but OECD countries, for example, have over 1,000 environmental taxes. And what Katie said, you know, it could create an impression that a company avoids taxes with a low tax payment, but in fact, if the company is using a tax incentive that is in the law and designed, you know, to use for stimulating investments in the green transition, then, you know, the lower tax payment can easily be explained. That's why the narrative is so important. And you see that increasingly, for example, in the Netherlands, the organized business community has also published a tax governance code for its members, with also rules, guidance around tax incentives, how to be transparent, how to relate to the tax administration. So I think it's getting more common than we saw 5 to 10 years ago, maybe even 2 years ago.
Okay, great.
And that's why the board should be involved, because the narrative is not in the hands of the tax director, of course, but in the hands of the boards and the supervisory boards. And I alluded to sustainability, and that's maybe an interesting topic too, Katie, because we think that sustainability and tax have also a relationship.
That's you're preempting my next question. So, where does the information need to be disclosed, Casey? I remember we had very interesting discussions about this. And is there any assurance requirements around that information?
Yeah. So you can report it on the annual website, the website of the company. And if it's not available, you can, for example, in a public registry, for example, the Chamber of Commerce, and it should be a report. So there is not a mandatory requirement that you really should report it in an annual report, for example. Okay. So it can be a separate document. But then I think it's interesting what Edwin mentioned, that there is a link to sustainability. So what we see now is a really huge development that they are including companies, the public country-by-country reporting, into, for example, a tax contribution report or a tax transparency report or even a sustainability report. And that is a very interesting development, I would say, because, for example, if you use that as a first step, for example, for the corporate sustainability reporting directive, then it's going towards limited assurance, because that is not mandatory under the public country-by-country reporting, but it is under the corporate sustainability reporting directive. So if you approach this whole thing, this public country by country reporting, as an element of sustainability, and it is a first step for reporting under the CSRD, then the whole sustainability report should obtain limited assurance. And then it is especially relevant for directors to really have a close look at this reporting.
So although, reward me, well, tell me if I'm wrong here, but your rationale is, although it's not specifically pointed out in the ESRS of EFRAG, insofar as you could consider that the company is materially significantly contributing by way of its income taxes to the communities around them and so on, this would have to be mentioned in their corporate sustainability reporting.
Yeah, exactly.
That would be the rationale.
Yeah, that's right. Because you can't see taxation as an ESRS. You can't find it, even not in a subcategory. But there is a requirement to think about other, for example, entity-specific disclosures. So you really have to think about other topics which could be material for a company. And often there is a long list, and then taxation is put forward on that long list, which could be material. And if you've done a materiality analysis, and the outcome is tax is material, and sometimes you see it like a tax transparency or a tax policy or responsible tax, so it has different variations. But if it is material, then you should report on it. And then it is an element of your sustainability reporting, which requires limited assurance. So,
I agree. And you can have a debate, of course, what's material. But if you take the view that about 50% of your cash flow is related to taxation, consumption taxes, wage taxes, income taxes, property taxes for a company, and I take that view, I must say personally, then tax is, well, very soon a material topic. You can also look at the risk related to tax, then you may have a different answer, but yeah, I'm not sure how you feel that, Katie. But,
yeah, I think that is a really good example. Another example, as I mentioned before, that the financial sector is a really front runner in all those tax reporting things. So what we see is that, for example, asset managers put taxation as a material topic, not because of their own operations, because it's relatively small, but the fact that they really have influence on the way they invest. That taxation is relevant and is material in that way. So that is really interesting, because then they have to reporting obligations to make their investment decisions. So you get a little bit the whole chapter of sustainable investment decisions, where taxes can be really relevant and material.
But I guess at some point you mentioned the examples of companies in the mining and extractive industries, and obviously we'll have more examples coming out the way. But it will be interesting to have some examples of companies, some form of best practices or with sound, robust reporting in that matter. Maybe a final question for you two would be, what would be your recommendations? Let's make 3-4 recommendations you would have for companies or especially directors as it comes to this new directive?
Well, one thing is, that's broader than this directive is have your data ready. And that's, I think maybe that sounds simplistic, but it's really complicated, because all these reporting requirements, new requirements around the global minimum taxation, for example, you need data. And sometimes those data are not available yet in the ERP systems and financial systems. So you really have to think about your data readiness and make sure that you collect and collate the data you need for all those reporting and tax requirements. That's the first one.
But I understand that for a subset of companies, extraction and extractive industries, mining industries, but also some of them by way of the non-public country-by-country reporting, they already have the data. Maybe not the system around this. That's what you want to say. Okay.
Yeah, but we see the new sustainability reporting requirements, of course. We see the global minimum tax reporting requirements, very complicated. Many of the data needed are not in the systems yet. So that's why I said it's more generic than and broader than this. Make sure that you get your data ready and understand what you have in the systems and work on getting those data in the systems, because that is very crucial. Yeah, understanding your own facts is also quite important, of course, that not only the tax director understands the tax position and the tax strategy, but all the business leaders in the business understand, from a shareholder point of view, but also from an investor point of view, the importance of tax.
Yeah, and I think just to mention the point you made before, for the data, I think the whole, and we mentioned it already before, the whole governance around this reporting process is also very important for directors. It's also part of your whole tax governance and your tax risk framework. Because it really is going public now, so it should be accurate and secure.
People in the business have to get a sort of sense, many of their decisions could have a tax impact and an impact on the company's tax position. That's in fact supporting your point, about risk management, making sure that the business is aware, tax governance, make sure that it is really deep into the business at the appropriate points, that people understand the impact on tax.
Yeah, so the tax impact, exactly the same way that we now have to look at the ESG impact of each of our operational decisions, I would say. Operating managers, operation managers have to think about their tax impact, and definitely that's a good point. Make sure that they have the culture.
And communication about tax, I think, is the most difficult thing there is. We are tax specialists, and we tend to talk in our own terminology. But when you communicate about tax to the public at large, then of course you should do that differently than when talking to specialists. So that's explaining to the public at large, the stakeholders, the investors, what your position is. That is, I think, really a challenge of some magnitude for boards and their advisors.
And obviously the discussions which will happen, I guess, at board level will be about tax risk appetite, definitely, and culture of the company at large regarding how they approach tax matters.
Absolutely, I think so. Yeah.
And I think it is also good to mention a practical side. For this whole public country by country reporting, you should report 12 months after the end of the financial year. But if you really approach it a little integrated with a sustainability report, then it could be differently, the date of reporting. So I think it is also good to be at least aware of the publication date of your annual report, your sustainability report, to really get an integrated view on your whole strategy, so that it is not isolated, publicated, but you get the whole narrative and the whole story about the company.
Okay, thank you. So my major takeaway would be data readiness, as you mentioned. Understand your own facts and set up proper tax governance across the board, but also deeper in the organization. Collaborate and consult, communicate clearly, and set good benchmarks and look ahead. Would that sum up your ideas in terms of recommendation for boards and companies?
Absolutely.
Yeah.
Absolutely.
And absolutely approach it also from a sustainability link.
Yeah. Definitely. That's a very good insight. I think we'll have to definitely think a lot about that within companies. We'll make for very interesting debates. Thank you very much.
Thank
for
you for
all
having
those
us.
insights.
Thanks for having us.
And hope to see you for the next steps.
Absolutely.